We think it will. The US economy is probably going to slow, but we don't think it's going to slow and go into recession. So, slower growth does not equate with recession. Number two, we think earnings growth is going to be good. Consensus earnings estimates for 24 and 25 are double-digit gains, which should be very positive. Third, we think the Fed is going to begin easing interest rates in the second quarter, which is usually very accretive to earnings, and that should be another positive cyclical factor for the equity markets. Four major structural trends, we think, in the US. Number one is the tech revolution, which is just beginning. Artificial intelligence and others will help lift productivity. Number two is the innovation that we're going to see in healthcare and other sectors that is going to push prices lower and create new business opportunities. Number three is reshoring or nearshoring of jobs, which will secure supply chain. And number four is the reindustrialization of the US, which will add a lot of technology and will create jobs in the US as well. In the US, we saw the peak in policy rates in July. Historically, when you see the peak in policy rates, market rates come down. That's a great opportunity for fixed income investors to extend duration and acquire those higher yielding instruments while they can. For equity investors, we think there's an opportunity here as rates come down. That is accretive to earnings, which should help corporate profits, and that's very good for equities. We think it is, because if you look at artificial intelligence and other new technologies that are coming, we're going to see this become much more pervasive throughout the economy. That is going to affect productivity. It is going to lift productivity and earnings. And we think that will be extremely positive for U.S. equity markets in 2024 and beyond. 2024 is a year of politics and geopolitics. Half the world is going to the polls. Clearly, for asset allocation, that means diversification. We expect to see slower economic growth this year. So we think clients should look at fixed income opportunities as we've seen the peak in policy rates, and that should mean lower rates going forward and improved returns in fixed income. For equity investors, we should focus on quality, and our overweight in the US is focused on the stability of growth and earnings. In terms of other asset classes, we look toward alternative assets as a diversifier for portfolios, and in a world of slower economic growth, that continues to make sense.